All righty. Check, check, check. Microphone check. All right, we're good. We're live, and we are back. Welcome to the I Love Annuities Podcast. This is Jeremiah Conger.
And I am Zachary Van Ness, and together we are the Annuity Dudes.
The Annuity Dudes. Today's episode is all about income, guaranteed income, but more importantly, we're taking a deeper dive into the top annuity providers for income in 2025. We're also going to discuss what makes them different and how some of the top offerings on the market lead over the rest of the pack. We're going to explain and break down exactly what you should be looking for and what to consider when making a better annuity buying decision. And it all starts with understanding the key areas to evaluate.
Yeah, and I think most importantly, really understanding how you can make a smarter annuity buying decision by using the multi-point inspection that we've added to our everyday routine.
Yeah, so over the years, working with hundreds and hundreds of clients across all 50 states, we've developed a method to evaluate and understand how to make better annuity buying decisions. And that's something that we've coined the multi-point annuity inspection that Zach just mentioned. But, you know, when we look at retirement, we understand that there is an income dilemma. And to be honest, income is everything in retirement. We've mentioned that in the past. And you can't just hope that the stock market plays nice over a 20 to 30 year period in retirement.
Yeah, exactly. And that's why more and more people are really turning to annuities with that income rider, especially when we pair that with strong option here with long-term care benefits. But not only annuities, not every annuity is created equally. So we've really got to dive in deeper, use that full inspection and find out what's important to that individual and their needs.
Yeah, you know, Zach, it's got to be pretty daunting when, you start down this path of maybe considering annuities and looking at an option or two, or, most of the time what we find is that, when people choose to work with us, they've only looked at one or two products at most. And it's generally because the advisor they're working with, that's all they led the conversation with was one product. And it's got to be daunting once you do your due diligence and you go on the, World Wide Web and start to research that annuity that somebody may have positioned to you, to find out that there's hundreds of others out there. And then you find out, there's all these other features and benefits. And, how do you make a good decision? How do you make a thorough evaluation of the available options? Everybody wants to get the most value or the most bang for your buck. And unfortunately, in today's day and age, even though many industries are led with technology, we've talked about it in the past that ours is so antiquated that there aren't really enough resources for a consumer to evaluate all of the available options. And that's where we've come up with this process. And that's really what we're trying and striving to do every day, is to bring more attention to a sound way to evaluate these options and giving you the ability to compare and contrast all of those. But today we're going to be reviewing the leading annuity providers through the lens of our multi-point annuity inspection, and that we believe every annuity buyer should know about. We're not here to hide all the secret sauce, right? We want to share with you what we use as advisors to help our clients make better decisions.
Yeah, and I think a situation that you and I both run into is in speaking with clients, we find that they were oftentimes suggested a product or maybe two products. And you say, well, how the hell did Jim get to this point where he's saying this is the best option for me based on an hour-long conversation? There's really no, our mission behind the purpose of this multi-point annuity inspection is that not only are we showing you how we're getting there, but we're taking what's important to you into consideration and making that decision. So it's not just the highest income that's always the best option. maybe that is the best choice for you. But how
Yeah.
did we get there? And really, being transparent and sharing that information up front.
I had gotten an email the other day. I don't remember what the gentleman's name was, but it was a prospective client, and he was telling me how he had gotten positioned a particular annuity. I'm not going to mention the name here, but it was one that has like this performance driven element to grow the income benefit. And he said it sounded too good to be true, and most of the time that is the case. And so what ended up happening is, I believe I forwarded that email over to our other senior annuity advisor on our team. His name is Matt. I sent that over to him. And then the other day I called Matt to ask how everything was going. And he said, "Oh, that gentleman that you sent me his info over, I got a meeting with him. And after speaking with him, he's like, come to find out, the advisor that he was working with, he's like, when he sent him the illustration, when the advisor sent this gentleman the illustration, he left out all of the guaranteed pages. He only showed him one page, and that was the non-guaranteed page, which shows those like really elevated income amounts, assuming these index crediting strategies went through the roof and drove the performance of the income benefit out of the water."
Wow.
And it's just a red flag. Like, that's what we're trying to change, is all of the wrongdoings in this industry. And there's a better way to evaluate these options, and I think everybody needs to know how to do it. And that's kind of where we've come up with this episode, is to share how we do it. And when consumers find out that not just is the income amount and things important, when they start to learn all of the other critical areas to evaluate to make a good decision, they find that, hey, maybe there's, a way to get not only just a great income, but some of these other features and benefits without having to compromise much to get them.
Mhm.
But you don't even know that those options exist when you're only positioned one product and you're not able to compare any of the others. And that's really what we want to do, is earn your business through trust and transparency, by educating you and lifting your annuity IQ to a higher level. So, Zach, why don't you take us into this multi-point annuity inspection process, and go? Let's go from there.
Yeah, I don't know if you wanted to share that graphic that we had as I go through this a little bit here. But yeah, really, how do we do that? Well, we use what's called a multi-point annuity inspection. This is what all of our advisors use. Over time and review, we've found that this specific framework is really just evaluating the companies and these annuities, really evaluating the carriers. And what we're looking for is a few checkpoints of what's important to our client base. So we're looking for highest guaranteed income, carrier rating, index crediting potential, income rider fee, and the enhanced income benefit for long-term care. So these are some features that we found to be valuable to our client base. And we take a closer look at these options in determining the best fit. The path that we take to get there is just understanding and having that conversation.
But let's go ahead and get into the screen share. So I'm going to go ahead and share my screen um, for the guaranteed income segment here. So we're going to open up our software, and we're going to talk about how we start to look at these products from just a guaranteed income perspective. Now, we're going to use one particular product in mind that comes up, and it's fairly competitive or popular, I would say, in many aspects. But it's not always the best scenario or best option in that scenario. So let me go ahead and share that and see if I can get this to work right without screwing it all up. We're not experts in this stuff yet. All right. Let me know if it looks good there, Zach.
You're good.
Okay. So what I'm going to do is just kind of talk to this. So, assuming that, the prospective client that we're working with, generally speaking, most oftentimes, not all, but most oftentimes, they're usually looking to compare an annuity that they've already been, positioned or pitched at either a dinner seminar or an educational workshop, or, their cousin or friend that's a alleged advisor, whatever the case may be, but they're usually looking to compare. And what we do is we start with looking at what is the primary objective of this annuity. And if it's an income annuity play, then that's really the starting point of the evaluation, is to start with the primary objective. We have to start there as the foundation and then build upon it the other areas of evaluation in our multi-point annuity inspection to then start, comparing and contrasting. And then what we do is we get feedback from you as a client or prospective client to ask you, besides guaranteed income, what of these other areas are important to you, and how would you kind of rank them in the sense of highest importance to lowest importance? Obviously, income's first, but these secondary areas, where do we evaluate them and rank them according to what you feel is most important, and more importantly, what makes you most comfortable? So, Zach, why don't you talk to a couple of the points here? I know we're looking at income, but why don't you talk to those points? If we were just looking at income, what are the things we're looking at here?
Yeah. So if we're just looking at the highest income, our software is automatically going to sort these based on a highest income in chronological order. So as you're looking at that, what you're going to find is as you're meeting with myself or another agent, we can search that criteria based on you yourself and your age, your time period of which you plan to wait to start that income. So we'll key that in, and then from there, the results will populate. And when we're looking at this, it's really going to show us whether it's a monthly or an annual amount, how much that will be. Right now, we're looking at one company specifically, and that's American Equity. This is frequently something that we find might be pitched or suggested. And then we'll dive in deeper to find out, is that truly the right fit for our clients' needs?
Exactly. So in this example, we're using the state of Florida, which is where we're headquartered, but we do work with clients in all 50 states. We work in a virtual capacity, so we're able to meet with you on Zoom right from the comfort of your own living room and help you evaluate these important decisions. But we're using a 60-year-old male and a 58-year-old female as a joint life structure for this annuity. We're deferring it out 5 years, where income will turn on anytime in contract year 6. And with this American Equity Income Shield product, which is their flagship income product, we'll notice a few things. Obviously we have it to where it's going to compute the guaranteed annual income. If we want to see that monthly, we can just hit a toggle button here and look at it from a monthly perspective. But really what goes into the income is the roll-up rate, which in this case, it has a simple interest roll-up rate of 8.25%. And then we'll notice how over the 5-year period, assuming they put $100,000 into this vehicle, we'll see what that income benefit base amount calculates to then determine what that income amount is going to be on a guaranteed basis. Now, what I will tell you, and I've said this in previous episodes, is don't just get caught up in the income roll-up rates. Like, none of that really matters. If you're really just trying to shop the marketplace on who's going to give you the highest roll-up rate, you're not always going to find the highest contractually guaranteed income, because there's multiple parts or elements that go into the formula, or factors, I should say, that go into the formula. It's income benefit base multiplied by the contractual payout percentage, which is determined based upon the age of the younger of the two annuitants. So these are contractual payout rates. So in your contract, when you get this annuity issued, it's going to have a payout schedule. And it's going to say, if you activate the income at this age, here's what the payout percentage is. So you take that, whatever that payout percentage is, multiplied by the income benefit value, and that's what will equal the annual figure, which we're now looking at monthly. But if you're just shopping roll-up rates, you're not going to find the best deal. You have to go by what's the contractually guaranteed income amount, and that's factoring in the benefit value and the payout percentage. Sometimes what we find, and maybe we'll do this later on in this episode, is you can find a really competitive roll-up rate, which will juice up the income benefit value. But what they'll do is they'll lower this payout percentage in the contract. So either way you slice and dice it, it's still a lower amount of guaranteed income.
Yeah, and that's really why we're trying to drive home the point of not getting caught up in, using the analogy, how the sausage is made, but the end result of how we got there.
Yeah. So what we're going to end up doing in this episode is we're going to really start to look at these evaluation points in the multi-point inspection. And then at the end, we're going to show you how we open up the entire marketplace to then start to compare all of them. And we'll see where that American equity ends up ranking according to maybe some of the other options that might be available once we take off that filter. But we want to use one product for now, just to kind of give your eyes a centralized focal point so that you can start to follow along and how to look at these.
Yep. Yeah, great point. So we're covering highest income guarantee. I think you had covered that while I was gone. So if we move on to the next point in that, using that 5 critical areas of what we're searching for in the multi-point annuity inspection, that would then be the carrier rating. So on that carrier rating, this is really where we're checking the insurance company's financial strength. And from our end of it, we can get a quick snapshot of what that letter rating is from that carrier. And really what we're looking for, as Jeremiah is displaying now, is multiple sources of ratings. Here you're seeing a rating from AM Best, Fitch, S&P, and Comdex. So we're really looking for a broad overview of multiple ratings that we can use as a source. I will say that we typically like to go a little bit deeper into that. Maybe you can elaborate more.
Yeah. So in addition to the letter rating, according to whatever agency you might be referring to, we also like to look at other areas of evaluation. One of those being, the balance sheets or the financial overviews of these companies, and that is kind of what the agencies are looking at, anyways. But it's really good to compare one company to the next, because you might have a company that is an A rating, and the next company is also an A rating, and so you're thinking everything's apples to apples there. But what we find is that that's not always the case. When you start to uncover their financials, you might learn that one A rating company might be significantly smaller from just the sheer size of assets under management versus the next A rated company. And sometimes bigger can mean better. It doesn't always mean that. But I know for me, if we're thinking about a 20 to 30-year window of income guarantee that we hope this contract will continue to pay out for, your guarantee is only as good as the issuing insurance company and its claims paying ability. So with that being said, I would feel more comfortable having a much larger, maybe longer tenured establishment backing my guaranteed income annuity, because I believe that if they're that large with that many assets, that they're obviously doing something right and they still have a really good financial rating. I would prefer a larger company than a smaller company. I hope that makes sense. So if, like, all things considered, if everything else is apples to apples, really you want to take a deeper dive into, hey, is this A rating better than this A rated company? Well, to find out, you want to know what size, how big are they from an assets under management perspective. And the other thing that we find, and I just did this exercise before we got on this recording, is you also want to learn what the capital surplus is of the company. So these insurance companies are required to have reserves, significant reserves, and just capital surplus. And we were comparing an A minus in this case to an A plus. And in my mind, I was like, well, the A plus is going to have to have probably better surplus capital than the A minus. And actually, it was the complete opposite. The A minus had just under 5% in capital surplus, and ended up being like 3.5 billion with a B dollars in capital surplus. And then that A plus rated company, it only had a 3.9% capital surplus, but it was still pretty large, the amount of money. But comparison analysis in terms of just percentage of capital surplus according to the assets and the liabilities, the A minus was better. And that actually won that client over to help them make a decision towards leaning that way, because they were already going that direction. because that income annuity actually provided more, just slightly more income. It also offered some other contractual guarantees, which we're going to cover in this episode, which the other company did not. So, ultimately it's about helping you make a more confident decision. And we do that by analysis. And these are the things that we look at.
Yeah, taking a little bit more of a step into that letter rating is important to us. It doesn't always mean that's the end all be all answer. So we're going to go a little bit further in that assessment.
Exactly.
Yeah, go ahead. I'm sorry.
No, I was just going to say, that's pretty much it with the ratings. It's pretty simple. You can always still take a little bit more of a dive into things like the vital signs, which will take a look at the specific investments of the issuing insurance company. It'll look at their bond portfolio composition. It'll tell us things like their non-performing assets and like what that percentage is of their overall portfolio. So there's a lot of things that we can look at to help you make a really, really good decision, and not just a really good decision, but one that you're confident in. That's ultimately our mission, is to help you make a better annuity buying decision. And it has to be a confident one. And the only way to do it confidently is to have education and transparency to know how to evaluate it to make that decision. And we understand that this is a really important decision, and it's one of sheer magnitude of just simply because you've never maybe even taken a withdrawal out of your retirement account. And when thinking about repositioning that money into a new asset that is unfamiliar, that can be difficult, that can be challenging or concerning and discomforting. So we want to make sure that we spend the time necessary to help you understand how to evaluate them and make a confident decision. And these are the things that we are committed to taking you through. Now, everybody doesn't require this. It's not required to go this deep, but I will tell you that it does make people feel good when they do it. And that's really the goal.
Yeah, and I've mentioned before, we like to get into the weeds of some of this stuff, and not everybody may want to go down that path. But if you want to find out more, we've got the resources and the tools to show more and provide you that information that you might be looking for, so that when you do make that final decision, you're confident in that decision.
100%. All right, so let's pull up the checkboard now again, and we're going to go into the third one, which is a biggie here, Zach. It's one that I feel is maybe the most under-discussed or misunderstood element of this inspection process, and that's the index crediting potential. And I know that people might be out there hearing that and saying, well, what does that matter? If this is an income play and all we want is guaranteed income, why in the world would we care about the index crediting potential if it's not tied to the income? Well, it's pretty simple. It doesn't just matter from a growth perspective, but really what it is there to do is to ensure that your account value stays strong in order to have things like long-term liquidity out of the contract, or to have a death benefit or a higher potential to leave a death benefit.
Yeah, and frequently this will get glossed over, right? So if we've met with clients before who will tell us, hey, all I care about is getting the most income I can out of this, or getting an income is great. I expect my account balance to go to zero, and that's fine. But if we've got a way that we can optimize this and use the tool for what it's intended for, then let's use it, right? So we've got this index crediting strategy that we can use. And I'll tell you, I would say over 90% of the clients that we work with, they just miss out on this. They don't, prior to coming to us and talking to us, they haven't fully grasped and understood how the index crediting strategies can really assist. And yeah, if that account value hits zero, we're missing out on a couple of things. That's that enhanced income benefit and the potential for liquidity or a death benefit. So a couple of key factors that can really add some value. If you're already buying it, let's use the tools that are there with it.
Yeah, exactly. And that's really where it's key to understand, is that most of those benefits, like enhanced income benefits, in most of these contracts, and I would say that about 98% of the income annuity marketplace that markets that they offer an enhanced income benefit rider, which is used to help increase the income amount in the event that you have a long-term care benefit. 98% of the contracts are going to have a fine print clause within those contracts that stipulates that if the account value is depleted to zero, then that enhanced income benefit is null and void. So in other words, if that account value isn't sustained long term and it runs out of money, while your guaranteed income will continue to pay you because that's in the contract, the enhanced income benefit, which is essentially a multiplier on that original guaranteed amount, in most cases it doubles to help pay any increases in your cost to cover long-term care. That benefit goes away. And what I find, and it's almost embarrassing to say this because it really puts a black eye on our industry, but most annuity advisors or agents out there aren't even aware of that fine print. And they come into the meetings like talking about this incredible enhanced income benefit and how it's going to double the amount of income if you have long-term care. And they almost like use it as like a Swiss Army knife where they're just pitching it as like a long-term care solution almost in addition to the retirement income. And in 98% of the products, that's never going to happen. That's never going to be available. But there are a few, if you're working with an expert, they can show you and educate you on which ones have a contractual guarantee on that benefit. But we're going to talk about that here in just a moment. But in this segment, the index crediting potential is essential to helping you secure that enhanced income benefit long term. Most people are going to need long-term care in their latter years of their retirement. And in a lot of the annuities that have this benefit, the index crediting potential is so lackluster that the probability of that account value being above zero and at the age that they need it the most, it's very unlikely. The probability is very unlikely that it'll ever be available. So it's definitely something that you want to be aware of. In addition to that, when you add in an income rider fees that are also eating your account value, it puts you in a vulnerable state that income benefit for the long-term care is not going to be there.
Right. So you've got the income being deducted from your account value. You've also got that income rider coming from the account value. So yeah, how do we sustain that account for a longer period of time? And that's through the index performance. But I think as a brief overview, just seeing some of these numbers on the screen, if we look at that returns column, pretty tough to maintain an account balance with potential returns like this.
Absolutely. And if you look at this, what our software here is doing right now is taking a look at every available index crediting strategy in this American Equity Income Shield 10. And then it's using a back test to identify the annualized rate of return when factoring in the participation rate or the cap or whatever the type of strategy it is. But you'll see these returns are, for the most part, pretty lackluster. There's one that looks pretty decent here, but I wouldn't write home that one's probably going to ever do that. One of the things that I'm very proud of in our firm is that we're experts on these indexes. And that BlackRock Adaptive, first off, it's a pretty fairly new index, and second, it's probably never going to do that return. And we will look at the analysis though to help you evaluate it to make sure that that's a true testimony that what we're saying is right. But we never just use the back test to determine which annuity we want to work with. We also look at the real-time performance of these index strategies to make a better decision. But yeah, if we were to illustrate this out, and let's see where we are in our segment, but if we were to illustrate that out, what do we got? Section 6 there. Okay, so we'll illustrate it out in a upcoming segment here in just a moment to kind of show you like how one may deplete, the account value may deplete sooner than later versus the next. I think that'd be a pretty good exercise.
Yeah, I like that. Yeah. So next segment we're moving on to is the income rider fee, right? So we've talked about how that account value can be depleted from taking the income, but also that income rider fee. And really looking at that fee, generally we're seeing those fees range between 0.85 to 1.5%, somewhere right around 1 to 1.5%, really. And when we're analyzing that, we're seeing that that's coming out of the account value. So how important is that to the individual or the couple? How important is that to them in sustaining that account balance? Again, going back to how this can affect the account balance, how important is that to them in maintaining it?
Yeah, let me get the window up here for the rider. And we'll take a look at that using our handy dandy American Equity, our friends over there at American Equity. We love
They're going to love us.
them. All right. So we have back up our calculator here, looking at the American Equity Income Shield just as a guinea pig example. And we'll notice that the income rider fee in this case is 1.1% annually charged deducted out of the account value. So when you look at this fee range and how it stacks up in the range, it's kind of in the middle of the road, maybe towards the lower end of the scale, which is good. You want to find if it's important to you that you have longer term sustainment of the account value. There's two things primarily that go into that equation, and that is how big is the income rider fee? How much is it, dragging down the account value? And the second thing is again, going back to the last segment, that's the index crediting potential. You need to have the best of both worlds. You need to have good index crediting potential followed by moderately low to moderately low income rider fee so that you don't have a lot of drag on there. So those are the two things that we would evaluate if you came to us and said, Jeremiah, this is definitely an income play. My primary objective is guaranteed lifetime income, but I really would love the opportunity to have my account value last longer, in a perfect scenario, last until I die. So I have a death benefit. The things you're going to want to look at, again, good index crediting potential, low income rider fee. Pretty simple.
Yeah, and I think it also adds another element there of having that lower fee. You've got the potential, in most of these, you have the potential to take out up to 10% withdrawal if needed. Not that we need that liquidity or not that that's intended for it. But again, having the options and being able to be dynamic in those retirement years is essential. So having that lower fee will really help with that.
Yeah. And again, if you don't have a secondary objective of caring for that account value and if it lasts longer or not, maybe you don't have a legacy benefit, or you should have liquidity elsewhere besides the annuity. Otherwise, it wouldn't be suitable. But if that doesn't matter to you, then neither should the income rider fee, in a sense, because it doesn't matter if it's deducting out of that account value and depleting it quicker than normal, or quicker than some other options. Then it doesn't matter. But that's really where it comes down when comparing apples to apples and finding the most optimal solutions according to what you deem to be important from a value perspective. That's where it's key. Do you value the carrier rating over the cost of the rider fee, or do you value higher income and not care so much about the carrier rating? So that's where we really take you through this engaging and interactive process to help you determine that, and then help point you and guide you in the right direction of which annuity options you should be considering. And then we'll go through, identify maybe a top 3 scenario according to your needs, and then start to break it down from there and look at these nuances one by one to help you make a well-rounded and thorough educated decision.
Yeah. Yeah. No, that's great. And really just hitting on the last subject here to round out our list. That's going to be the enhanced income benefit, which you had briefly talked about when we were looking at the index performance. So a big one that we consider here, and if this is important to someone or not, that enhanced income benefit for long-term care feature that can double, either at least multiply, whether that's 1.5 or 2 times. It can double your income for up to 5 years if you're unable to perform 2 out of 6 activities of daily living. So we're looking not everybody may have this on their list, but it's a consideration in making that decision.
The way I look at that, because some people have a long-term care. I hope that most people have a long-term care plan outside of this annuity. But to be honest with you, long-term care is one of the biggest crises in retirement planning because most people haven't planned for it, and by the time they have started, at least with this baby boomer generation, it's too late because they can't qualify for the more affordable long-term care coverage. The traditional coverage through the life insurance part of the business. And so what happens is that they start to look at other options, and knowing that you can find these benefits in an annuity is pretty great. But that's where you have to make sure you're not getting into a trap, right? You're not getting into a product that says they offer it, but the likelihood of it being available when you get to the end of the road there is very small. So that's where, like I said before, there are a few carriers that have either a contractual guarantee that they'll offer that enhancement on the income benefit for long-term care, regardless of what happens to the account value and if it depletes to zero. And then there are other companies that may not have a contractual guarantee, but they do have stronger index crediting potential to provide a better opportunity for long-term account value sustainment so that enhanced income benefit is available and there when you need it most.
Yeah. Yeah, I think that's a great example. And really, we've seen some examples in which that fee is, 2%, or can go up to 2%. So how's that really going to help somebody if we really are relying on having a feature like this and having that enhancement?
Yeah, exactly. Can you see my screen, Zach? I'm sharing our friends again at American Equity here on the Income Shield.
Yeah, I can see
So
it.
they have a few different rider options in this particular product. And if you go with option 4, that's where it unlocks what they call their well-being rider. Sounds great. Love it. Really cool name. And you'll notice that in this case, on a joint life basis, it's getting a 1.5x multiplier.
Mhm.
If you had a need for long-term care and you qualify, being unable to perform 2 out of 6 activities of daily living, the $743 in monthly income would increase to just over $1,100 a month, and pay that $1,100 a month for up to 5 years to help cover those increased costs from long-term care. And the rider fee goes up on this one 10 basis points to 1.2%. But I really want to show you an example of really, what could potentially happen if maybe you had a need long term for that long-term care, maybe later on in your life. And if you don't have good index crediting potential, or maybe you have too much drag from the income rider fee, what can happen? Now, can you see this, Zach? What is it showing on your screen?
No, I still see your screen with the income.
Okay, let me share it. Let me try it again here
Yeah.
real quick. I had to change windows. That's what happened. Where is it? Here it is. Guaranteed. Here we go. All right. What about now?
Yes, sir.
All right. So what we're doing now is we're breaking out into an illustration. And in this illustration, I'm not going to cover the guaranteed values. That's pretty simple. It's just assuming there's never any interest earned from the index crediting strategy. And it's just showing you the example that your income is guaranteed for the rest of your life, even if the account value here on the left in the green column depletes to zero. But the point of this exercise is to show you that this is a product that may or may not have the enhanced income benefit rider when you get to the end of your road and you have a need for long-term care. And so here what we're looking at is your contract value or account value, which is what we've been referring to it as in this episode. You have your annual withdrawals column, which is the lifetime income rider, which we illustrated to be deferred for 5 years, turning on in year 6. And now we have this credited interest rate column, which is introducing the back-tested index crediting returns using the last 10 years, and they're just projecting that out forward-looking. And what we're going to notice here is that once that income turns on, because of the amount of cash flow being produced by that income rider, the index returns and the sequence of those index returns and the income rider drag from the fee it starts to erode this account value. So you see it pretty much going down every year. And before you know it, in this case, it actually lasted a little longer than I anticipated. But at age 85, there's $0 going into the next year because of the account erosion. So in this case, if you lived a really long life, that enhanced income rider benefit may not be available. And all that time you were planning on it potentially being there. So that's something that we see in some cases. You have to understand that none of us have a crystal ball to know what the markets are going to do in the future. And we also don't know what the sequence of those market returns are going to be in the future. So this is just a simulation. This doesn't mean that this would happen. It could be the complete opposite. It could be way better. It could also be way worse. But what we do know is that if having an enhanced income benefit is important to you, you at least need to have a really good index crediting potential available from that annuity contract. And what I would prefer to do, and it's what I've been doing with our clients, is rather than putting all of the premium investment into one annuity, if we identify that they have a secondary objective for long-term care and they want that benefit, what we're doing is using a multi-annuity strategy where we'll use like one really good high income guarantee, and then we'll diversify and go pick another one. So for example, if they're doing $300,000, you could go buy three $100,000 annuities, and you're kind of piecemealing them together based on the objectives. All of them are going to offer guaranteed income, but what we're doing is mitigating the risk. If we're in just one product that doesn't have that enhanced income benefit guaranteed in the contract, we're mitigating that risk, and we're buying a couple annuities, at least one, but maybe two out of the three that have contractually guaranteed enhanced income benefits that even if the account value depletes to zero, we're going to you still have that benefit available. So it takes all the risk out. It takes all the pressure off of the index crediting to continue to perform, and it gives you more peace of mind that we're dialing in your objectives and right fitting the annuities and the overall strategies, excuse me, to hit your primary objective and your secondary objective of long-term care.
Yeah, that's a great point. And I think one other element that may be considered if we're going down that path of what it would look like to have multiple annuities owned for the purpose of lifetime income is now by creating that structure of having several. Now you can also start them at different points to turn the income on at different points in time. So taking that approach can add a lot of value in different areas when we're looking at the annuities.
100%. And that is really key too, is like, optimizing the strategy. What we find is that there can be really far more optimal solutions when it comes to creating lifetime income. You don't have to put all your eggs in one annuity. At least the position, the amount of money you're wanting to position in. You don't have to put them in one. You can still, if you like one product and you love what it does and you love the way it grows the income, or maybe has an enhancement on the long-term care, if you like it, you can take that tranche of money, and instead of putting it all into one contract, you can break it out over several, and then you can leverage the guarantees in the income rider contract to defer longer if you only need some of the income out of the gate. So I actually have a client I'm working with on that right now. He's doing 750,000, and he only needs about 300,000 right now to service his current income need, and the other 450,000 we're deferring it out long term, 5 to 10 years. And because of the guarantees in the income rider contract, we're able to continue growing that income benefit pool using guarantees rather than, if he were to leave that money in the market and just hope that it does well, he doesn't have to now take that unnecessary risk. He can take advantage of those 8%, compounded roll-up rates, and really have a lot of confidence that that income is going to be there, and he knows exactly how much it's going to grow to when he needs it.
Yeah. So by looking at the right product, it can provide some extra value, really, and provide remove that uncertainty when that time comes with that long-term care, or like you had mentioned, maybe something that's an inflationary tool of starting that income down the road.
Exactly. So I think this would be a good time now to just to kind of tie it all together and show you how we would now look at the entire annuity marketplace using the same scenario that we typed into our calculator with a 60-year-old male, 58-year-old wife, joint life structure, $100,000 premium, deferring it out 5 years, and kind of see how we would now start to look at this, knowing that we have a framework to base our determination and our decisions on. So
Yeah.
I am going to open the software up and let me
Yeah.
know when you can see it.
I can see it. Yeah. And just going back to why we utilize this tool, we had made reference that sometimes some clients come in, we talk to them, and they've been suggested one product, or they've met with 3 advisors and they were suggested 3 different products. Well, that doesn't sound like a right fit. Why don't we just take a look at the marketplace together and find out what fits your needs, as opposed to me telling you there's one answer?
Exactly. And so we're going to look at this, and as we just now have uncovered, and this is kind of a scenario that we run into quite a bit, where someone was pitched a product and that product wasn't actually the best one available, just from a primary objective perspective, just looking at it from a lifetime income perspective. The reason that we're able to do what we do is because we are an independent annuity advisory firm. We truly care about our clients' best interest, and we're required by law to care about them, not just from a moral and ethical perspective. We also are legally bound to it. Our headquarters is in Florida. It's one of the early adopters of the annuity best interest standard, and we're proud of that. And we've been that way before that regulation came into existence. And we have relationships with every carrier and every major uh, insurance marketing organization, so that we can bring the most amount of product to you to help you make a better decision. And that's something that differentiates us from most other agents, advisors, and firms, because I mentioned on a previous episode, the average amount of like annuity products that one advisor or firm sells is 3. I remember recently I had a meeting with one of the broker dealers that we work with, and we hadn't been working with them all that long, but we had started with them just to have access to a couple products that they have. And they said, man, you guys have been with us for a few months and we've never seen a team of advisors have such a widespread amount of products that they've wrote deals on, that they've put contracts in for. And I said, what do you mean? And they're like, you have like 20 different annuity products that you've written over the last few months, and most advisors only write like 3 or 4. And to me, I was like, that's mind blowing.
Yeah.
But it's because we're different, and we're proud of that, and we want to make sure that you're getting the best value. The only way to do that is to have access to every product.
Yeah.
So what we're looking at here is we've undone the filter that we had applied just to show that American Equity Income Shield, and we are using the same exact scenario. But now what we're seeing is that these are being ranked according to highest amount of guaranteed lifetime income on a monthly basis after 5 years of deferral, and we'll see how the companies start to unfold. So we have Corebridge at number 1, Delaware Life at number 2, Athene at number 3, Nassau at 4 and 5, North American at 6, and then here you go. Here's American Equity at number 7. Not saying that they're a bad deal or anything. I'm just saying this is how we have start to evaluate is who's going to offer you the highest contractually guaranteed income, since that is the primary objective here. And then from there, we drill down into the multi-point inspection. So Zach, why don't you take us through how you would, look at this multi-point inspection when working with a prospective client? How would you take them through this?
Yeah, I think number one in using that multi-point inspection is finding out, of those 5 key points, which of those top options or which of those key points are the top options in someone making that decision. Is that highest income guarantee the top option? Okay, well, let's categorize that as the number 1. If you told me The second most important thing for me in making this decision is the carrier rating. Okay, let's categorize that as number 2. And then if you said, okay, beyond that, I want that enhanced income benefit or another feature. Well, now we can put these in a categorical ranking of what's important to you in making that decision. And then we can take a look at the software that we've got to use that tool and find out which options are best. So really what we're going to look for in that scenario, again, highest income guarantee. If we needed to make sure we've got the carrier rating, I'm going to go in a little bit deeper and we're going to find that right there. And lastly, if I want to take a look at how we can sustain that account value for a longer period of time so I can use that enhanced income benefit, then we're going to take a look at those key features of that fee, the crediting from the index performance, and the potential to sustain that account value for a longer period of time to use that enhancement. And not, the other thing to consider is not every enhancement feature is created equally. Some will be that doubling effect. And as we see in this example right here, this is a joint annuity. So this is a joint lifetime income, and that enhancement feature actually doubles. Not every carrier has that feature for a joint policy. So again, finding out more about what's important to that client and their needs to create the right answer, or the right solution.
Exactly. And then in addition to that, not only is some of the carrier options for joint life where they'll double the amount of guaranteed income, others will only offer a 1.5%, or excuse me, 1.5x multiplier on the income benefit for joint. But another nuance to that is that some of these enhanced income benefit riders stipulate that you can only use that benefit if you're confined to a qualified nursing home facility, or others will offer the ability to use that benefit and qualify for it even if you have that skilled care at your own home. But not all of them allow it to be used at your own home. Some of them have a requirement that you have to be confined to a qualified nursing home facility for at least 90 days or more. And the way that we know the difference is our software here is designed to identify whether or not they require you to be at a nursing home or if they don't. So you'll notice that these first couple, let's use the Delaware Life and this one from Athene, you'll just see that in parentheses, it says 2 of 6 activities of daily living. That's an indicator that if you qualify, then you can use that benefit and they'll pay you that enhanced amount, even if you're getting that skilled care at your own home. If we come down to this North American product, you'll see in parentheses, it says nursing home. That means in that contract, it requires you to not only be unable to perform 2 out of 6 activities of daily living, but it also requires you to be confined to a qualified nursing home. So those are the nuances that most people don't know about. Half the time, the agent talking about this doesn't know that. And that's what we're trying to do, is just shed light on these areas of opportunity for improvement so that we can help, consumers make better annuity buying decisions. But I know that there's agents watching these videos and listening to these podcasts because I've gotten a couple comments, and I'm hoping that we're making a difference with them too and lifting their annuity IQ to help them represent our industry in a better way.
Yeah, this is something that, if we're putting any dollar amount into it, any premium that goes into it, it's a big decision. So we want to get it right. There's no reason that we should be glossing over this information or putting a half-assed effort into providing the right information. I think a lot of times we might have a meeting where we meet with somebody for the first time and we've spent some time uncovering what's important to them. And at the end of that meeting, we find out, they tell us, hey, I'm not ready to make any decisions yet. Well, I sure hope not. We shouldn't be ready. We've got more information to cover, and we want to make sure that we're fitting to your criteria of what's important to you.
Exactly. And that's critical. And, this isn't a one and done type of decision. Typically you should be spending at least 3 to 4 meetings with the person you're working with to truly do the thorough evaluation. That's what we usually run on is a 3 to 4 meeting process. We encourage people to take their time. We encourage people to do their due diligence. We encourage people to sleep on it, pray about it, talk to their wife about it, talk to their dog about it, talk to their kids about it, talk to their pastor about it. I mean, the list goes on. We encourage that. We want you to do that. I can't tell you how many times we've had to like pump the brakes because people love our process so much and they get so much confidence and clarity in doing this that they want to just move forward because they were working with like a nightmare experience before coming to us. But we pump the brakes and we know that, hey, I know that you're happy with this and you want to move forward, but let's pump the brakes. Let's take it slow and let's make sure that at the end of the day here that you're confident in your decision, but it's going to take time to get there. And I know it feels good now, but at least sleep on it and let's meet, next week and reevaluate and see where you're at.
Yeah. Yeah. Great point. Yeah. So if you want to pull up that list one more time, again, we're really using this multi-point inspection as a highlight and as a tool to really understand specifically if we're looking at a fixed index annuity with an income rider, how we're grading or how we're determining what's most important in that process of making that final decision.
Can you see the screen here?
Yeah, you're good. Yeah, thank you.
Yeah. So we're going to go ahead and close it out here. Just to do a quick recap, our multi-point inspection highlights these 5 key areas. We have the highest guaranteed income, the carrier rating, the index crediting potential, the income rider fee, and the enhanced income benefit for long-term care. Now, again, these stack rankings are customized by you. You're going to tell us what matters most to you and what you feel the most comfortable with. And by doing that, it allows us to take you into an interactive process to truly handpick or select which annuity is right for you based on the way you feel about these inspection points. And, I will tell you that it makes a lot of a difference, especially when you're educated on how to evaluate these areas and you're confident in the carrier and who's representing the product. You're confident in the contractual guarantees with the income rider fees or whether or not it has an enhanced income benefit. And at the end of the day it's going to add a lot of value to you when it comes to sleeping at night, because like Zach said on a past episode, these are sleep at night annuities. These allow you to get a lot of peace of mind and worry-free enjoyment in retirement, because you're now creating an independency from the markets on your retirement income, which in our opinion is your biggest asset in retirement. Income is king. We're getting those t-shirts made.
Right.
Zach's working on it right now. We're also sponsoring a fishing tournament here since we're located in Florida. And one of the shirts we're having made, it says income is king, but it has a kingfish on it for any fishermen out there. So we're actually pretty thrilled about that. It's going to be a lot of fun.
Yeah.
And that tournament, by the way, goes out to a good cause. It's I don't know if anybody remembers this, but I don't know, probably 5 or 7 years ago now, maybe even longer. There were 2 young kids that had went fishing out here in the Atlantic, and they chose the wrong day. It was kind of clear and pretty calm in the morning, but some storms kicked up in the afternoon, and they were in a slightly smaller boat. I think it was like an 18 or 20-foot boat, and it ended up capsizing. And they found the boat floating like off the coast of Jacksonville by the time they found it, but they never found either of the boys. And I think they were only like 15 years old. So it was pretty devastating to the community here. They were from Jupiter, Florida. We're located in Stuart, Florida, which is just 15 minutes north. But the tournament is a memorial and tribute to them, and the proceeds go to a foundation for educating the youth on boating safety. So we're really proud to be a part of that.
Yeah. So we'll be out there representing a good cause. Hope to meet a few viewers and listeners. But really, if we want to spend a little bit more time here, really what I wanted to mention to wrap this all up here is if you do want to see which annuity is best for your situation, We invite you to go through this process with us, and it's completely free, right? I have that question so many times of, okay, well, what do you guys charge? We don't charge anything.
And people are kind of shocked by that too, aren't they?
Yeah.
Yeah.
They're just kind of waiting for it. Yeah.
Yeah. So there's no fee to work with us. How we are compensated is whichever annuity and product that you decide to work with and select and apply for, whichever company is representing that product, they pay us directly. So it doesn't come out of your premium investment. You're not charged any fees now or in the future for our service. That's all taken care of by the insurance company specifically. So we would love the opportunity to serve you. We're confident that we can help guide you in the right direction. And if you're interested in doing that, you can start by finding the link here in the show notes or description of the video, wherever you're watching this or listening to it. And there will be a specific link that you can do one of two things. You can either request a free report, which will provide you an annuity report with the highest rates, income rates, carrier ratings, and things for 2025. Or there will be a secondary link there that you can just directly book a meeting and speak with one of our senior annuity advisors. And we can get the ball rolling and helping you make a better annuity buying decision.
That's right.
So,
And as we've said before, we believe annuities should be bought, not sold. So really spending that time to empower yourself with the transparency and the right data that we provide is a valuable tool, again, available at no cost.
yeah, and you have really nothing to lose there, just everything to gain, right?
Yep.
So you maybe invest an hour of your time to see if maybe what you're looking at is the right decision. And, either it is and you were able to validate that, or maybe there was a better product for you and you just saved yourself a lot of headache and also some money, I'm sure. So you have everything to gain there. But either way, we hope we have added some value in this episode. If you have enjoyed this episode, please like, share, ring the bell, like those fancy YouTubers say, and we would really appreciate that. So, with that being said, thank you so much for tuning in to another episode of the I Love Annuities podcast. This is Jeremiah Conger and Zachary Van Ness signing out. The Annuity Dudes.
See ya.
Let me do an end out show. Here we go. End out. Yeah. All right. Fade it on out. All righty.